So joining me now is Dan Greenhaus, the chief strategist over at Solus Alternative Asset Management. Dan, this is an amazing rally that we've seen, and the election was just the latest catalyst. So what exactly are the conditions you see that will drive the next leg higher in these markets?
Hey, Dom, happy Thanksgiving, first of all. But listen, the conditions are everything that we've all been talking about on the network for the better part of a year or two. The economy continues to expand. The labor market continues to hold up well. Real incomes have moved into positive territory, and corporations are still pretty profitable. And I don't see anything in the next, call it 3, 6, 9, 12 months that's likely to change that narrative. And if that's the case, then the bias for markets should be exactly as it has been, which is to the upside.
Now, you mentioned this idea that the markets overall are relatively expensive, especially if you look at that forward price to earnings ratio basis. Is there a reconciliation that needs to be done amongst investors for the levels that we are dealing with now? And by the way, as a follow-up to that, Dan, I know that you're watching this closely. How much do interest rates have to go lower to keep this momentum going, if at all?
Well, listen, the market is certainly expensive relative to its own history. We're 21 or whatever times earnings. But given the strength of the technology names, which disproportionately trade at a higher valuation, then that's going to drag up the broader market valuation. And so it's the normal way you would contextualize this argument is to say, well, the rest of the market is less expensive, and that's obviously true. But you have to, if you're going to argue that the market is going to correct on a valuation basis, you have to explain to me why Nvidia, Apple, et cetera, are going to correct. And right now, all the fundamentals in place for all those stocks remain the same, which means that I don't expect, and I'm not sure the average investor should expect, some meaningful correction in the short term. So that's the first point. With respect to interest rates, I don't think you need a meaningful drop in interest rates to sort of support the broad market valuation for the reasons I just mentioned. Again, Apple's not trading where it is, Nvidia is not trading where it is, Microsoft is not trading where it is, because the 10-year is 4.25 instead of 3.25 or 5.25. They're trading where they are for fundamental reasons. So I'm not as focused on the Federal Reserve as everyone else. And in fact, I have a bit of a differentiated view. I know the consensus expects a cut in December and then call it 4 cuts next year. I think that sounds awfully ambitious to me. They may indeed cut in December, but 4 cuts next year, given what's going on both economically and with respect to inflation, that seems a little high to me. I think something like 2, perhaps even 3 cuts seems much more reasonable than the 4 currently anticipated.
I'm pretty sure, Dan, I think a lot of folks in the market are starting to gravitate towards your side, seeing that we don't have to be so aggressive with interest rates if the economy is holding up generally okay.
That's right.
As we head into 2025. If you do, we mentioned the broadening out aspect of this marketplace right now, and it's not necessarily Mag 7 that's leading the way higher. If it is going to be this broadening out trade, Dan, where exactly do you then see better opportunities? Are there certain parts of the market, sector-wise or market cap-wise, that you think are the better positioned ones for 2025?
Yeah, listen, I think we've been talking about this on the network, again, all year. Obviously, Mag 7 and large cap tech in general, ServiceNow and the other non-Mag 7, but large tech names that have done well are really driving a lot of the focus. But everyone has paid, obviously, heed to what the banks have done and financials. The AI derivative plays, as I've called them, not Nvidia per se, but the names that are ancillary beneficiaries of the expansion of AI have done exceptionally well. And some of those are in the industrial space, like the HVAC names. And you've got to build the data centers. All of these different plays are doing well and are likely to keep doing well as long as those funds and that demand remain in place, and they do. And then something that Solus has been harping on, and I've been making the point on air for 2 years, is this just constant worry about the looming and imminent death of the consumer is something I haven't believed in. The data hasn't supported it. I know there was a big focus for a while on the excess savings data point. I didn't believe that either. The consumer looks real healthy to me. Obviously, there's pockets of weakness, particularly at the lower income side of things. But the consumer looks real well, and where we have found value over the last year or two, and probably over the next year or two as well, is being exposed to names that are doing well in that space that aren't necessarily, call Kohl's, let's say, although if you look at a chart like Brinker, a name that we're not involved in, they own Chili's. That it looks like a tech stock. But that's a good example of the type of consumer name to which you can be exposed to say, okay, the consumer's doing fine, but it doesn't have to be Macy's. It doesn't have to be Gap stores per se.